Hello everyone, welcome today. Thank you for making the time to come and see us. As you all know, it was the budget yesterday, so thank you for joining us on our budget summary and our panel discussion. On our panel today is Sumit Agarwal, James Bland and Adnan Ali. So Adnan is the senior banking and real estate finance leader with over 15 years experience across major institutions, now serving as Head of Relationship Management and Lending at GB Bank. He oversees GB Bank's residential and commercial real estate lending strategy and has structured facilities of up to £30 million and has facilitated over 250 million, I think, in just the last 3 years.
Yep.
Adnan is recognised for his client-focused approach, market insight, helping property investors, landlords, and access the right finance and drive sustainable growth. Next on our panel is James Bland, highly experienced chartered tax advisor and affiliate member of STEP. Over 25 years experience now, I think, James. Specialist expertise in inheritance tax and private client taxation. Graduate of University of Cambridge, James has built an exceptional career advising high net worth families, property owners, business principals on some of the most complex aspects of UK tax law. James's core areas of specialism include property taxation, trusts, family investment companies, strategic inheritance tax planning. His technical depth combined with a pragmatic client-focused approach has made them a trusted advisor to both families and professional intermediaries. So as you can guess, there's good reasons why we work very closely with James and have been for a number of years now. He's supporting the firm's in-house tax team, so Sid and his tax team, so many of them are here today, across a wide range of matters to ensure clients receive clear, commercially sound and tax-efficient advice. James's ability to translate complex legislation into practical planning makes him an invaluable contributor in today's discussion. And finally, on our panel is Sumit Agarwal, founder, managing partner of the group, DNS Group, one of UK's leading accounting and business advisory networks. Also my boss, so say that happily. 20 plus years of experience has grown DNS from a home-based practice, as I said earlier, into a top-tier firm. We're currently at 61 in the UK. We're waiting to hear where we are this year and believe we may well be in the top 50 based on the figures I've seen, but we'll soon find out. Serving thousands of small businesses, contractors, landlords and property investors across our 45 plus offices. Sumit is passionate about building teams and mentoring, and he brings his deep commercial expertise to all areas of business and taxation. As a passionate advocate for business growth and financial clarity, Sumit offers practical insights on how policy shifts may impact SMEs, freelancers, and property owning clients as well, which I know we've got a fair few of you here today. Before I go over to the questions, I'll just go through a few key highlights. Most of you will know this, so I'll read it off here as well. So on income tax, thresholds frozen now till April 2031. The stealth tax that we've all been hearing about. Dividend tax changes as well. Savings income changes in April 27. Also, ISA is still exempt, but 20k ISA allowance and 12k for cash ISA below 65 as well. VCT income tax relief 20% from the current 30%. Okay. On property tax, changes from April 2027 as well. High value council tax surcharges also on properties over 2 million and 5 million tapered there. On inheritance tax changes, bans frozen until 2031. APR, BPR 1 million combined allowance for 100% exemption and 50% thereafter. 2 million for couple and unused pension pots IHT from April 2027. Business tax, AIA at 1 million retained. Main rate written down allowance, 14% from current 18%. New first year allowance, 40% for new P&M. 100% FYA on electric cars extended to March 2027. Business rates, RHL reduced by 5 pence, SBBR 1 to 3 years. And other staff pension contributions above 2,000 through salary sacrifice will attract NICs from April 2029. From April 2026, no tax relief for home working expenses unless reimbursed by your employer. Employee ownership trust, CGT exemption reduced from 100% to 50%. EMI extended to larger businesses. EIS annual investment limit increased to 10 million, lifetime limit 24 million. Okay, so just a very quick summary of the key points announced yesterday. So I want to start with a question for all our panelists. What is the single most important takeaway from yesterday's budget for our audience of landlords, private clients and business owners, and why? So if we can start with you, Sumit.
I mean, this budget is, I personally feel this budget has one good thing, nothing drastic, nothing major, except hammering landlords with a bit of tax, which they were planning for everybody, and dividend taxation. So investing, landlord, anything, they're making it tough. But apart from that, nothing special, freezing the allowances. So it was a timid budget for me. Nothing bold. Chancellor trying to keep some big things for future if required. So overall, I would say they can be a lot worse. They could have been a lot worse. So it was not a huge damage, and they can manage to recover 26 billion extra. Hopefully, let's see next 3 to 6 months, the economy grows or not. But overall, timid budget, not much for business. Landlords and investors needs to plan a little bit more better on their returns. But to me, she played neutral, not huge.
Thank you, Sumit. James, your thoughts?
I'd agree with Sumit on that. I think it wasn't as bad as we thought it was going to be. It was interesting. I think a lot of the scare tactics that we'd seen didn't arrive. I suppose what I'd take from it is that we don't assume this is the end of it. So the things that we thought might happen, like an exit charge and things like that, I suspect probably will happen in the next budget or the next budget. Budgets used to be quite boring. Budgets are now getting more exciting, if that's the right word from a tax point of view. Interesting, yeah. So, you know, the things that if what we were worried about wasn't in the budget, we need to keep on worrying about it and still probably need to do something about it. Because it wasn't in the budget of yesterday doesn't mean it isn't going to happen.
Thank you, James. Adnan?
So from the banking side, I mean, there was a lot of nervousness around in the banking field about what would happen. Everyone was trying to predict how the markets would react. The biggest takeaway we had is that the budget kind of calmed the markets, is what we saw. That makes a difference to us because we're not expecting any sudden movements on the rates. I mean, we kind of know where we're gonna be at, I think, this time next year. And I think that directly for a lot of investors, landlords, people that own property, they can kind of now know what their cost of borrowing is going to be, and they can sort of plan ahead for that. For our clients, it was more just that there was no sort of sudden shocks. There was nothing which was majorly concerning. And I think the lending environment, us as banking, we kind of feel a bit more calm. I think we know when the next rate cuts are going to be. So I think it gives us an outlook for 2026 that we kind of maybe wasn't expecting because there was nothing overly surprising in there. So for us, it was actually, from a banking perspective, nothing too concerning. But I think there will be a lot that will happen in the next couple of years, which will affect the markets. But this budget didn't really change much for us.
Thank you, Adnan. First question then. In light of yesterday's budget and the broader political regulatory mood towards private rented sector, is it genuinely still worth being a landlord in the UK? And how do you see the buy-to-let and wider rental market evolving over the next 5 to 10 years? So if we can start with you, Sumit, on that.
I mean, as a landlord, I've been landlord now for over 20 years. And if I recall the time in last 20 years, what has gone wrong, I mean, this is one of the toughest time for a landlord. This is the toughest time for the industry. Maybe the property people related to the trade, whether it is planning consultants, whether it is the people around development, renting, now new Section 21 being scrapped. So it is one of the most difficult time, I feel, as a landlord in 20 years. If you ask me, would I start? I'd think 10 times, and I'll have a clear strategy. You cannot be a casual landlord. You cannot be a landlord who creates a buffer. Oh, I'll save a couple of $100,000, I'll get 20 grand rent, and that will be my pension. That strategy, that thought process is failed. It cannot work anymore. So as a landlord, for me, it's one of the most difficult, challenging times. The property market will get some hammering. So you look out for deal. Don't jump into yield-based mindset only. Look into the management, risk. And I would say next couple of years is not about yield or debt. Next couple of years is more about buffer, safety, caution. I would suggest that don't be over ambitious, be more grounded, and you do the deals if you have money, do JVs. Rather than borrowing, think of creating pools, structures whereby you can come together and invest, because that risk is far more less than debt risk. So that's my only thing. I mean, taxation has never been challenging as a landlord, but being a landlord, this is one of the toughest environments, and it may get even more tougher. So create a buffer. So if you have 20 properties and 12 have got debt facility, or all of them 20 have got debt, maybe sell 10, reduce the debt. Maybe create 5 properties without debt. So that would be the kind of approach I'm thinking, because it is going to be very tough making money. You never know what kind of tenants you are sitting with. There may be time bomb ticking. They may not pay you from April 2026 onwards. You don't know what's going to happen. And court system, justice system is broken. It may work sometime, it may never work sometime. So let's say out of 10 cases, if you're stuck, you may get good result in 2, but if you go to the court, it can take 2 years, 3 years to get them sorted. So you can be out of income very soon. So be very cautious.
Thank you, Sumit. And then from a lending and risk management standpoint?
Yeah, I mean, if somebody asked me, is it still worth being a landlord? I would still say yes. I still think there's no better value, I think, when it comes to appreciation than it is in property. But I think now you're definitely seeing, as bankers, we are now seeing a definite steer from more landlords to become more professional in the way they do things. Where I think in the past, for those of you that have been in finance would remember, you could get 100% mortgages, 110% mortgages, them days are long gone. So to invest in property now, you have to have a bit of capital to start. Those already are in the industry, lenders still want to lend. The market is still strong. Values are dropping. I mean, we're a bank based in Mayfair, but we cover the whole country. I mean, we've done approximately about £500 million of lending on buy-to-lets in the last year. So we're still seeing a lot of traction in the market. Yes, the foreign investment money isn't coming in as much as it was maybe 2 years ago, 3 years ago, but there is still demand for London. There is still demand for property in the UK. But I think definitely for the landlords, it's definitely now becoming more apparent that you have to be more professional in terms of your setups, your structures, having it in a company. So as banks, we look at not only what the income is, what your costs are going to be towards the income. And years ago, management costs were a lot less than what they are now. Even stuff like the minimum wage rising means that any cost related to staff suddenly have increased. So your margins are dropping. But one thing that we have seen is the rental market is still very strong. The rental market is still going up. Rents are not, from what I can see, are not going down. So whilst the values still are, the demand for rentals is still there. So yes, I think the market will still be strong. Values are dropping. I mean, we speak to valuers all the time. The likes of Savills, Knight Frank, JL, all the big guys, and they're all telling us that central London Mayfair properties, the values are dropping from what they were 2 years ago, but the demand is still there. And you do, as a landlord, if you get lucky enough to get a distressed sale, you can still be quids in. So I think you definitely have to be a lot more conscious about what you're putting money in. But generally, the market is still strong for buy-to-lets, as long as you can now factor in that your margins are going to drop. But if you can manage it in a professional way, I think the market is still quite strong. And we predict it still to be like that for the next couple of years.
Thank you, Adnan. Another question for you. With higher taxes on property, savings and dividend income, how will lenders look at serviceability and risk for landlords and SMEs over the next couple of years?
So, those of you know, banking isn't the most exciting industry. So most banks have a sort of tick box exercise of, your income needs to be this on the property and can it be this much of your mortgage repayments. Some banks will take a more holistic approach. They'll look at, if you're a successful landlord and you've got other properties or other developments or other businesses, then they'll factor that in. But generally, yes, your margins are dropping. The cost of everything is going up. For example, a lot of developers at the moment are really struggling. That's where we're seeing a massive reduction. We as a bank, for example, don't do development finance, so we don't do ground up developments because the margins are so much tighter than what they were. So implications of everything going up means that I think development is the one industry within property that I think is going to be tough unless you're buying something which is, like I said, on distress for very cheap. We as a bank, and most banks at the moment, are more aligned to stable income and stable portfolios as opposed to will this development work, because we know that the cost of setting up a development now is so much more expensive.
Thank you, Adnan. Next question. What are the most sensible steps landlords should consider now in terms of structure, debt levels and portfolio strategy? Sumit.
I mean, from my perspective, as Adnan said, that yes, they're very keen to lend, they're lending a lot of money, but looking for better deal, better ROI, not play on the margins, keep more buffer. For high-end properties, I think the market can be very tight because of new mentioned tax, so that has to be considered. But overall, I would increase the margin. So if I'm thinking of ROI on my property at 10%, I may have to start thinking of 12% on the gross interest. So this means the property prices will go down and you have to find the deal. Unless until you're buying home for living for yourself, or the deal making will be much more tighter. So this means we can expect next 6 months very turbulent in terms of transactions, in terms of volume. And so it is a adjustment phase for next year or so. But overall, if I'm a landlord, I will be doing a lot more JV, lot more rather than debt. This is my personal preference. I'm not against bank debt, but I'll be doing a lot more JV. I'll have on my team a lot more experts rather than just myself as a landlord. So together as a robust structure, and I'll be always looking for deals, because if we have cash in hand, even if you're not able to do the deal, you will sooner or later find better deals. So don't rush for the deal. Don't have a FOMO effect. Focus on right deal, right location. Once you fix your location, don't look all around the England, please. You will never find anything right. Don't go for yield basis, but focus on your area. Give yourself some time. Sooner or later, you will find the deal, and rentals will keep on increasing. So eventually, every time government brings new legislation and all of these new things, eventually somebody has to pay. Otherwise, there won't be any landlords.
Thank you, Sumit. Adnan, do you want to add to that as well?
I think just when it comes to, a lot of those of you that are landlords or wanting to be landlords, I think it's just review your debt levels. We saw a few years ago when I was with a different lender, the base rate was 0.1. And we used to get tons and tons of inquiries of people that wanted to borrow money on variable rates because the base rate is going to stay at 0.1 forever. And those of people that were smart, they knew that the rates, those people that have been in the industry know that these cycles happen. Some people remember when interest rates were double digits, and that was quite common. So I think it's all about not overreacting. now we're seeing people starting to do their fixed rates on shorter periods because they know that the base rate is starting to drop. I think we were at 5.5, maybe 18 months ago. Now we're at 4%. We're expecting another rate decrease, maybe, I think in February or March. So now people are fixing for a shorter period. So it's all about just reviewing your debts and not, don't try to play the market, if that makes sense. I think it's all just trying to strategize and look at your portfolio and what can it bring you. If you have a good asset with a good yield, then there's no problem with putting it on a longer period because your rental should still be up. So it's just about looking at your affordability and seeing where your portfolio fits in with the market, not the other way around.
Thank you, Adnan. Question, I'll start with Sumit first on this one. Is transferring properties into a limited company structure now the right move? What are the real costs of incorporation, and does it actually work in practice?
Yes, transferring into limited company always works, but firstly, whether you qualify or not, if you're a landlord with 1 or 2 or 3 properties, unfortunately, despite your will, you may not qualify for tax-free transition. You can transfer the property from sole trader to limited, but stamp duty, CGT may not be worthwhile. So if you do qualify, yes, I will always highly endorse to transfer the property to limited company and have that flexibility and have that corporate structure. and control, because if you have borrowed and you have debt, you end up getting relief on interest, only 20%. And that is one of the worst structure as a landlord or business owner to have. So if you qualify and if covenants and banking allow, you should transfer. Now, costs really depend on the portfolio, but the timeline can be usually you transfer from sole trader to LLP, then to limited. There may be incorporation direct. There is one legislation, but tax experts can tell. The cost really, I don't want to comment. It's from each accountant to accountant, case to case. But I think something from $5,000 to maybe $5,000 plus upwards cost, something like that.
Thank you, Sumit. James, do you want to comment on that as well?
Yeah, I mean, I agree with Sumit that generally a company is the best place to own property. So if you're coming with a big pot of cash and you're going to buy property, generally a company is the best place to do it. A lot of the clients that we see have already got property. So the question is, should I put them into a company? The answer is mostly, and, I'm being a little bit vague, but, the client really does need to look at the scenario, do the numbers and actually see how much better off they're going to be. If you're £1,000 a year better off, $5,000 plus to set it up may or may not be satisfactory. If you're sort of $3,000 a year better off or more, it makes more sense. Interestingly, there was something in the budget about incorporation relief. So Sumit talked about some transfers qualifying for release. That basically means you don't pay any capital gains tax. Now, previously, that was an automatic relief. You didn't even need to claim it. You got it automatically. The revenue changed that, so you will have to make a formal claim for the relief. And basically, the revenue's thinking, I think, is to give them some more information. So they will know everybody that's claimed the relief, and they can open an inquiry into people potentially that have claimed the relief. So it means that people incorporating are going to have to be more careful. I think get some advice to say, do I qualify? Do I meet all the conditions? Because if you get a challenge and the revenue win, there's a lot of tax at stake. So it's, I suppose in summary, yes, still the right thing to do, but with care and looking at your particular circumstances.
Thank you, James. Just shows the importance of getting that expert advice at each stage. Next question. By cutting the under 65 cash ISA allowance to £12,000, but retaining the £20,000 overall cap, is the government intentionally steering savers towards equities and risk-based investments? Sumit.
I mean, yes, the government wants, I don't know exactly if they only want to invest in UK, but we may see in future, they might tilt it even further, that you can only invest in balance 8K only in the UK equity market. So they're trying to pump up equity market, EIS market, startup markets. So the government do not want people to hold too much cash. They want to push the economy, and this is a direct tax-driven way that if you want to invest full 20K, you can only invest up to 12K. You can only invest 8K in the company, then 12K in cash. So yes, it is push towards the economy and investment.
Thank you, Sumit. Next question. Pensions have typically been viewed as outside the estate and thus advantageous for HT planning, though this perception is evolving. Given this shift, how should the traditional approach of spending other assets before accessing pensions be reconsidered? What updated sequence would you recommend for drawing from pensions, ISAs and taxable portfolios? And if I can ask James to answer that one.
Quite a big question.
Yeah. A bit of a mouthful. Yeah.
I mean, the change in pension rules is horrendous, I think. It's not come in yet. So if, not to be too blunt about it, dying before April 2027 might be sensible. But seriously, when money comes out of a pension, as we all know, it gets taxed pretty much at 40 or 45%. We've all put our money into pensions on that understanding. And now it's a case of somebody dies, they pay 40%. And then when your children take it out, they pay another 40%. So they've got about, depending on the numbers, around 36% left of what was in the pot when you died. So that change is coming in. There was nothing in the budget yesterday that suggested they weren't going to do it. As I say, it comes in April 2027. I think what it has done is changed, or ought to change people's mindset. So the advice that most people would have been given before is your pension is the last thing that you touch. Spend your savings, spend your ISAs and all that sort of stuff. Leave your pension because it can obviously go nicely to your children, inheritance tax free. It's almost changed on its head. It may be that you do start drawing on your pension. If you've got pots of cash or investments or property, you probably need to start looking at transferring them into trust or giving them away and actually using your pension. So drawing down on it, taking your lump sum, perhaps giving the lump sum away, taking an annual amount or a monthly amount, and then you can gift it away under what's called the gift out of excess income rules. The government are trying to encourage people to use it as a pension rather than as just a store of value that you can pass on inheritance tax free. And I think they'll be successful in that. But if you've got a decent sized pension, why would you put more in? You probably wouldn't at the moment. So it's not going to encourage people to save. But generally, I think everything's flipped on its head. So to answer your question, Gary, you'll probably look at taking things out of your pension a lot more earlier than you might have done.
Thank you, James. With IHT nil rate bans frozen to 2031 and targeted relief changes such as the new structure for businesses and agricultural assets, what practical planning should families and owner managed businesses be thinking about? Again to James.
Yeah. So this is quite funny that they've frozen again the nil rate bans from, what was it, to I don't know if anybody ever thought they were going to go up. So it's not a great surprise that they've frozen them. They've been the same since 2015, I think, or 2010, I think, isn't it? So yeah. So I don't think they're ever going to go up. And it's a very sensible strategy if you're the government, because it drags more and more people into to inheritance tax. So we've got a plan on the basis that they're probably never going to go up, certainly under the current government. The one good thing in terms of inheritance tax that was in the budget was that so everybody will now get £1 million allowance for either agricultural assets or business assets. And previously that wasn't going to be transferable. So if I've got a £2 million company that I own half with my wife and I die, I can't give her my allowance, but I can obviously leave her my shares. So she'll have a £2 million company and a £1 million allowance. So they have said they are going to allow that allowance to be transferable now, which is something. What they haven't done is capped gifting. So that was a real concern of ours, that they would say you could only give away 100 grand or 50 grand a year to your children or grandchildren, and anything more than that has an immediate tax charge. So they've not done that. So I think people should be thinking, if they can, about gifting assets to the next generation, because I do think they will cap gifting at some point. Obviously not yesterday, but maybe next year. So it's one of these sort of watch this space, I think.
Thank you. Next question. Freezes to thresholds and higher effective tax on investment income mean more fiscal drag. What practical steps can higher rate savers and investors take in the next 12 to 18 months? And I'll start with Sumit.
From high rate tax savers, in a joking point of view, I would say that when you invest any pound, because if you save anything, like in pension, it is worth only 36p. So technically, when you're investing in a pound, it is only, think this way, that you're only spending 36p. So spend more.
Do you think it might trigger more entrepreneurs to look to leave the country?
Yes, definitely. All my clients will definitely think, anybody who is above 150k, they're already thinking, that is on their cards from the perspective of looking abroad. Now, most popular people talk about Dubai, but they're also looking in a lot of places in it. Europe, whether it is Italy, Portugal, and it is a natural choice that every year when a budget comes, anybody with a good wealth, good asset base, they're planning every year that what should we do, whether it is good or not. From my perspective, if you have children settled, if you can live anywhere else, those are the people who are moving abroad easily. If you are tied to your children, you're looking after them, unfortunately, you may not be able to do much, but many people are really thinking going abroad.
Thank you, Sumit. And James, any thoughts?
Yeah,
on that?
I was going to say that, but you beat me to it. I think generally you've just got to work a bit harder to be more tax efficient. So you've got to look at things like ISAs, for example. Now, as Gary said, ISA allowances are going down, but they're still there. You can still put in, was it 12,000 in cash and £20,000 in stocks and shares. Obviously, the good thing about ISAs is they're completely tax free. So don't waste those allowances. I think people probably should look at companies a bit more. So income tax rates have gone up, but corporate tax rates haven't gone up. So if you're going to have lots of income, a company might be a place to have it. There's lots of benefits. And one of the facts is that if you have a certain amount of income, if you go over £100,000 of income personally, as you probably know, you start to lose your personal allowances and they take other bits and pieces off you. Whereas if that income is in a company, it's not counted as yours. So you don't lose your personal allowances. And then you let it accumulate in a company paying tax at 19, 25%. And you'll pay tax when you take it out, but you could take it out at a certain point in time. Maybe you've moved abroad. maybe you're not such a high rate taxpayer anymore. Maybe your children are 18, you can give them some money. Maybe you can put some pension contributions for your children. So, these are sort of nibbling around the edges sort of scenarios. But if you have lots of, savings here and there and that, they can add up. So I think it's a case of having to plan more and more carefully and not just sort of leave it to chance, really.
Thank you, James. Next question. Family investment companies continue to gain popularity. Under what circumstances are they not the right structure? We'll start with you, James, then go on to Adnan.
Yeah, I suppose I sort of touched on that earlier. Companies, they are useful. The same point with not everything is not for everybody, if you see what I mean. So they are right for the right sort of people. So family investment companies, they can be quite complicated. So it's not, you don't just stick 50 grand in it. You need to have a reasonable amount of money to make it worth your while. There's obviously setup costs and there's the sort of running costs. Some people just like a very, very simple life. And you're not necessarily going to get the most simple life with a family investment company. There's always a trade-off between efficiency and having that sort of simple life. They have to be structured correctly. So we do a lot of family investment companies using trusts and things like that. So I think it's a case of trying to keep it simple, as simple as it can be. But no, I think they still have a place, and I think we'd still look to use them. Yeah.
Thank you. And Adnan, is it funding for FICs?
Not necessarily. One thing that I would say is those of you that have got property portfolios where you're looking to involve the children of the wider family, just make sure they know what they're doing. Because we have had, we see a lot of landlords, property experts, portfolios that come to us and they suddenly given their children a 10, 15 million pound portfolio, and suddenly the child wants to leverage it at maximum debt because he sees a nice penthouse in Park Lane which he wants to buy, not knowing what they're buying. So my only thing would be, if you're going to involve your family in your portfolio, and children especially, just give them a bit of guidance. Because as banks, that's one thing that scares us. And we see that a lot. But we do see a lot of structures in terms of trusts being put in place. We see a lot of SPVs where children are directors and shareholders. But I think what you need to kind of be careful is, if you are involving them in the portfolio, essentially they can ruin it. As much as they can develop it, they can also make it go the other way. So just be conscious of that.
One thing. Family investment companies are not for if you want more flexibility, if you want to take out cash, dip in, dip out. They're more for protecting future growth, using the trust structure to give the existing assets, but mainly for protecting future growth. Very good. But if you're looking for liquidity, flexibility, there is a lot of tension between the family, then they may not be the great idea.
Thank you, Sumit. Many may ask whether it's the right time to accelerate lifetime gifts, trust planning or corporate structures before the next election or budget. What are the top 1 or 2 no-regret actions you think families should consider? And that's a question for James.
Yeah. I suppose what I'd say is, we think this tax situation we've got now is bad, but it's better than it will be next time and the time after that. So we'll always look back and go, actually, we used to be able to do that, and now we can't do that. So while we can do things, and I will come to the point, we ought to do them. So if I was a revenue, I'd be looking and saying, right, we're putting inheritance tax up in the sense that we're freezing allowances and we're reducing reliefs. So what's the natural reaction of people going to be? Well, they're not going to hang around. They're going to probably start to gift assets down to their children or into trust earlier than they might otherwise have done. And if they do that, they're not going to pay inheritance tax. So we have to stop them making gifts to their children. Now in Ireland, I think I'm right in saying that they have an annual gifting limit. It's something like 50,000 euros. I'm not an expert on Irish tax, but so in other words, if you're in Ireland, you can't give more than 50,000 euros or pounds away in a year before you have an immediate tax charge. Now at the moment, we have nothing like that in the UK. If I was worth £1 billion, I could give £1 billion away to my children tomorrow. All I need to do is survive 7 years. And actually I can take some insurance out, so I don't even need to do that. So in a sense, we might look back at the system we're in now and go, that was really generous, if the revenue bring those things in. So the question, or the answer to the question is, if you can afford to give assets away, so let's say you've got a family business and you're thinking, right, well, I've got some children, I'm always going to give them some shares, but they're not quite ready or whatever, or I'll do it in the future when I'm feeling that I want to do it. Those sort of decisions perhaps need to be accelerated, giving assets away now, because in the future you may not be able to do so.
Thank you, James. Next question. Business owners face higher dividend taxes and restricted pension salary sacrifice. How will this reshape the way people extract funds from companies and high earners save for retirement or supplement income? Sumit, as a business owner.
Yeah, as a business owner, I mean, make sure that you claim all the expenses, allowances. Many business owners, sometimes we are very casual, not claiming all the expenses, allowances. Of course, we may have to make a provision for extra 2% tax on dividends. So if you have set expenses, so you have to earn either 2% more or you have to provide from your net income extra 2% tax for the dividend as a business owner, which if you are very, very tight on the money, it can be tough. So you will have to readjust your expenses, or you may have to increase the charges to your customers to make more money for the taxes. But main thing is that make sure that you use all the allowances, you use all the expenses to maybe reduce the taxes as a starting point, but also look at your making more money, increase the prices by 2% to take up the profit by 2% up to make up for the taxes. Eventually, I mean, and worst case scenario, if you cannot survive, you have to cut down on the costs.
Thank you, Sumit. Next question for James. With the budget now restricting EOT capital gains tax relief from 100% to 50% and tightening some of the conditions around these structures, do you still see EOTs as an attractive succession route for owner-managed businesses? And in which situations do they now make most sense and available alternatives? EBT, buybacks?
Yeah, so for people who don't know, an EOT is an employee ownership trust. So the idea was that if I've got a successful trading company, I might sell it to Sumit for 5 million, but I'll have to pay capital gains tax, maybe up to 24%. Whereas actually now, under the EOT regime, I could have sold it to him and paid no tax on it. So it was very, very generous. It's something that George Osborne brought in. So then they're taking away so they've called it 100% relief. So rather than paying 0%, I'm now going to pay half of what I might otherwise have paid. So now I'm sort of paying 12%. I think they've probably killed the EOTs because there is a lot of cost and perhaps hassle that sometimes comes with EOTs. So you've got to look at you've got to do a cost benefit analysis. So the difference between 0 and 24 is obviously very, very big. So it's worth the additional costs and hassle. But now we're talking the difference between 12 and 24%, or 12 and 0%, same thing. Is it worth the hassle? Because if I sell to Sumit, I'm going to get all my money straight away, probably. But if I sell to an EOT, I'm effectively getting it out of profits. That might take 5 or 10 years. That's a long time to wait. And something might go wrong and I might not get all of my money. So maybe it's better to have all of my money and pay tax on it than to not get all of my money. So I think it's really going to slow EOTs down. There were some changes in the last budget, so it's not helpful, I think, for EOTs. But there'll be some scenarios where they'll still exist, I'm sure.
Thank you, James. Final question, actually, before I'll ask you all to make a closing statement. This one's for Adnan. Interest rates and lending criteria are still tight. Are banks expecting more arrears, false sales, or consolidation across businesses in 2025?
We hope not. We don't want to get arrears, but I mean, we do. I think the fact that people over the last year have started fixing on a longer period gives us comfort that we know that they're going to be able to service the debt. Do we see a lot of arrears? I mean, to be honest with you, you'd be surprised. A lot of people, the one thing that they do, property experts, is they make sure that the mortgages are paid and paid on time. And as banks, we have enough buffer. We put covenants in place to monitor. So generally, I mean, no one expects to get more arrears or more defaults in their book. But like I said, our biggest risk in the last year was developments, which we pulled out from. So there, I think, is where we see a lot of distress. A lot of developers, a lot of contractors are going bust because the costs are rising. I mean, even yesterday I had a deal land on my desk for an asset that was worth 32 million sort of 9 months ago, and somebody's picked it up for 13 million because the contractor went bust. So these deals do go in the market, and you do see what we call NPAs, so non-performing assets. But generally, most lenders would have enough covenant and enough buffer to cover themselves. But you do hear some horror stories, for sure.
Thank you, Adnan. So that was the last question I had. So if I just go one at a time, start with you, Sumit. Some final thoughts on the budget yesterday?
I mean, from my side, this is not a time to be super ambitious if you don't have liquidity. Build buffer, be cautious, and do the structured deals. I mean, debt, if you can get a great rate from Adnan, great, but don't go stretch yourself 70% liquidity. I would say if you were thinking 70, think about 60 and make the deal work. I mean, you have to be pushy. Don't be softy in negotiating the deal, because if you don't have buffer, I don't know how the market will react after Section 21, how much rent increases you can do. I mean, that is also one thing in my mind, that all the costs are going up, like mainly in the high rental market, property market, with mentioned tax will be the landlord paying. I don't know how much they can push for the rent increase, so buffer has to be done. It's a timid budget. Chancellor protected themselves. They kept a lot of big ticket items close to their chest. As James said, they may come with exit tax, they may come with more stricter limits on gifting. So make hay while the sun shines. So if you're thinking of doing something, this is the right time. Do not delay. Don't feel like, oh, we have managed to get away with it, because until the books are sorted, market will keep hammering. UK bond markets will be tight. They're also interlinked, and their main goal is to make sure that the inflation is controlled. So from that perspective, I would say, as a business owner, as a landlord, you guys need to be safe. If you can get away with increasing prices 5-10%, go for it. As long as, and it's a good excuse as well as a business owner, that look, taxes have gone up, we can't pay from our pockets, and the prices can go up. So.
Thank you, Sumit. James?
Yeah, I mean, I suppose I'd say, inheritance tax is my main thing, so that's maybe where I'll concentrate on it. But income tax, you only pay the income tax on the income that you've got. Capital gains tax, you only pay on the gains that you've made, the profits. Inheritance tax, you pay on everything. So whether it's income or it's everything that you happen to own when the music stops. So it's the most tax that you will each pay in your entire lifetimes. So, well, actually, you won't pay any of it. That's the good news. Your children will pay it, so don't worry about it. But it's probably the thing that actually will cost your families the most. And, Sumit's actually right. You build these things up, but when you build them up, what you're really doing is creating a nice big pot for Rachel Reeves or whoever is the Chancellor. I mean, she probably won't be the Chancellor next year, but whoever's the Chancellor when you die, to come and take that big bite out of it. So that's the thing I think you need to think about. And actually, we haven't seen that many changes in inheritance tax. There are still quite significant things that you can actually do. Putting assets into trust, giving assets away to the next generation. I would say use these next 12 months to think about that and sort of move it as far as you can outside of the scope of the Chancellor. Now, if you're moving assets down to the next generation, I mean, a lot of you guys are quite young, and perhaps your kids are, you're not going to want to give it to your kids, but you might have parents that want to give it to you, for example. You are kicking it down the road. But if you're going to pay some tax, would you rather pay it today, or would you rather pay it in 30, 40 years' time? So, I think that's what I'd be thinking about.
Thank you, James. And Adnan?
From our perspective, I had a meeting with one of the directors at Savills only last week, and he gave us some very positive outlook on values of properties and where he sees the market. He says in the next 2 to 3 years, we will see gradual increases in values going up. So those of you that are investors and landlords can be confident that values will go up. I think from lending perspective, this time, maybe 18 months ago, I think was the most difficult, when the base rate just kept jumping up and up and up, and it was just constantly looked like it was going to be bad news. I think now we're starting to see the rates drop, and now people can start planning and people start knowing what their affordability costs are. We see 2026 as being a good year. We still see a lot of traction in the market, but I think, like Sumit said, if you can, we as banks like to lend money at lower leverages. I know you may think that we want to give all the money out, but we don't. But there are still people that are very active in the market. And if you can afford it, leverage is a great thing if you know how to manage it properly. So we're still hoping, and we've got our 2026 lined up, and we think it's going to be a good year. So the market, I think, is positive. I think we've definitely had probably the worst of it last year, in the last 3 or 4 years. And I think now we will start seeing the road to recovery, I think.
Thank you, Adnan. I think that's a nice way to finish. I just want to say thank you very much, Adnan, James and Sumit. Thank you.